All right, we are back with the Mechanics of Money with my friend Tait Duryea, and I think this will be a really interesting episode too. So Tate has a background as a pilot, and then really focused on the real estate space for quite a while, and has made some pivots that I think he has some really good insights around why, right, tying to the macro space, tying to the environment too. But I'll let Tate cover more of that. So Tate, thanks for coming on.
Thanks for having me, Sam. We've known each other for a long time. Nice to be doing a podcast together. Thanks.
Yeah, so want to give the audience from your background too. I think the corporate side kind of more in the pilot space, which actually gives us a really good bridge to what you do today too. So why don't you kind of cover more of the corporate pilot background?
Yeah, so I'm an airline pilot by background. I grew up in an aviation family. I'm actually third generation airline pilot. And so I started flying airplanes when I was like 11 years old. And, I love flying, it's in my blood. But, real estate and alternative investing and entrepreneurship has always been in my heart. And coming out of high school, I almost went down that path. Instead, I ended up flying, but I never really lost that entrepreneurial itch. And, I see that in you. And, we say that being an entrepreneur is a condition more than an occupation, where it's just something that you're drawn to. And even though, I had a very successful career in flying, and I actually still do fly for the airlines, just not very often. I'm usually in the air maybe 4 days a month. Started my firm about 6 years ago after a successful, decade investing in real estate, and now have built this private equity firm called Turbine Capital. And in any case, I've pivoted to that really full time, and it's a blast.
And I think you do a really good job on it too, where your entire brand now on the private equity side is all focused around your background, right? And I think people, have a big accelerant if they go take that competency and brand they have from their, thing people know them for being successful, and right, you on the pilot side, and taking that to actually they're in business now too. So walk us through the branding and kind of positioning around what you do, and kind of who it is you work with there too.
Yeah, I'd say 85, 90% of our investors are pilots, and we have quite a large investor network at this point. We're the largest airline pilot investor network in the world. But with that being said, there's quite a lot of bleed around the edges. There's a lot of doctors and business owners and attorneys and engineers that invest with us as well. To your point, though, on the branding piece, I think that, when I was building my firm, really the genesis of building the firm from the beginning was the fact that the aviation space did not have a trusted source for education and deal flow in the alternative space. And that's something that is prevalent when you look at the physician space, even dentist groups. I mean, you see a lot of that in those doctor or niche audiences where you have a concentration of high income W-2 professionals that have some commonality between them, trust each other. And because that didn't exist in the aviation space, I decided, well, it's high time that did exist. And so we set forth and we built it. I think that for anyone who has a specific niche, a specific profession, if you're looking at getting into the capital raising space, it definitely helps to leverage. There's a saying that if you're talking to everyone, you're talking to no one. And if you're trying to differentiate yourself, especially in the beginning, you're trying to get a toehold in the market and get your first few investors through the door, so then you can build a track record, so that you can build a firm. It's very difficult to get those few investors when you don't have a story and there isn't some commonality between you and those first few investors. 10 years down the road, when you have hundreds of millions of dollars under management, you have an amazing track record, you're going to be able to attract investment dollars from every corner. But when you're first getting started, it really does help to have that niche and to have, some common ground with your initial investor base.
And so walk us through kind of what that dynamic was for you, right? Starting in real estate, right? Kind of what was that first experience for you, and then how has it pivoted over time the last handful of years?
Well, I'm a huge proponent of real estate, always have been. I started buying real estate, just single family properties when I was in my mid 20s. transitioned into some commercial, and then realized, I'm picking up scraps as an individual investor. And that's when I pivoted into the limited partner investing space, and then eventually into, climbing into the GP seat and partnering with larger operators, as well as other JV partners, and driving some of these larger deals where there's more zeros at the end, and obviously just more economies of scale. You get better talent. We've all heard that story before, where, it just doesn't make sense to bang your head against the wall. If you're a W-2 professional who's making 400, 500 grand a year or more, is it really worth your time to own and manage a sixplex? It's more work than it's worth, right? Your time is better spent doing whatever it is you do very well, obviously, to make that kind of money in your day job, and allocate those dollars as a limited partner into some of these bigger deals. Or if you want to add more zeros to the end of it, then yes, partner with some of their operators, go take down a $10 million building, and then all of a sudden, it's the juice is worth the squeeze there. Your question, though, alludes to, how did we get started? What do we focus on, and where are we pivoting to? I would say that we're very asset class agnostic at Turbine. We've built the firm intentionally to be very diversified. So we participate in, I'd say, 6 different verticals within commercial real estate. We're very focused on the industrial and senior housing segments right now. Those are complicated. Well, senior housing is a very, very complicated segment. Industrial is pretty straightforward. It's just that you need to be very careful where you're buying, because you can find either highly vacant segments of the market or really tight segments of the market, depending on where you're buying.
And industrial,
Senior,
like what kind of property actually is industrial? Like walk us through what a typical asset looks like.
for sure. So industrial, basically, if you're looking out the window of an airplane and you're looking down, you'll see these big warehouses, right? But you've probably heard that, industrial vacancy is very high. That really tends to be concentrated in the big bomber facility space. So 500,000 square feet, 500,000 square foot buildings and up. Those tend to have been overbuilt, especially in markets like San Bernardino. Think Amazon warehouses. If you filter by smaller than 200,000 square foot buildings, really smaller than 150,000 square foot buildings, and for functional obsolescence, the vacancy rate is actually sub 2%. So what I mean by functional obsolescence is, let's say you are a manufacturer and you want to rent this building. It might be 100,000 square foot industrial building in a great location that's close to your offices or other logistics hubs. The problem is that the clear height is only 14 feet, and you need an 18-foot clear height in order to use it. So that is going to show up as vacant on a CoStar report, right? But you got to dig a little deeper to see that it's not for lack of demand, it's for lack of functionality. So I think that if you are buying in the right markets, in the right segment of the industrial market, there's some really good buys there. And obviously the multi-decade trend of deglobalization, bringing supply chains back home, bringing manufacturing back home, is driving those tailwinds. So that's one of the reasons why we're bullish on the industrial market.
Cool. And so walk us through senior living too, right? To my knowledge, I don't know a ton about it. That's much more operator focused, right? You actually have to have a key person leading the operational piece of it too, besides the real
estate. Yeah. You're talking about senior housing now?
Yeah.
Yeah. So senior housing is a very complex asset class. This is not like, hey, I'm going to buy a multifamily building, put a tenant in there, call it a day. You're talking about, nursing. You've got massive regulatory environment. You have a lot of liability. So this is one of those areas where you really have to find an operator who knows their stuff, who is entrenched in the regulations and has an amazing track record. It's a very complex asset class. But if you can solve that piece and you can partner with the right people, it is the 80-year-old plus population in the U.S. is the it's the fastest growing segment of the population in the U.S. It's growing by more than double the rest of the population. There's currently about 15 million people in the U.S. that are over the age of 80. That number is going to grow to over 25 million in the next decade. And we're at a 15-year low in construction starts. The big boom in construction that we saw post-pandemic in multifamily, industrial, and really every other commercial real estate asset class, we just saw this massive supply wave on the cheap debt and just plethora of cash that was sloshing around in the market post-COVID. Builders went nuts. Well, COVID obviously crushed the senior housing industry. And so we actually wanted to get into senior housing before the pandemic, and I'm glad we didn't, because NOI cratered by about 40, 50%. A lot of companies went bankrupt. I mean, it was a really, really bad time in the industry. And because of that, everybody skipped that construction boom within the senior housing space because they were still crawling themselves out of a hole that COVID had caused. So we are, you look at the charts on this, and you look at the construction is anemic, the starts on construction on this stuff, and the population is booming. And it's just, it's a complete no-brainer in terms of demographic tailwinds and the undersupply. The other thing to consider is that baby boomers control over 51% of the wealth in America. So, and the first ones have started turning 80. You've heard the term, the silver tsunami, and it wasn't really materializing until now. And so those first baby boomers are turning 80 now. And if you don't think that they have the money to pay for dignified and inspired accommodations for their later decades, you're dreaming. It's sad to see that the majority of the inventory in the United States is something that you walk into, and it's quite frankly depressing. And we want to participate in elevated, dignified, beautiful, luxury developments that people can afford.
Yeah, it makes a lot of sense too. Like if you have an asset class that got pretty dinged up during a period of time, the
Right.
likelihood that construction is going to go boom, likely just isn't happening. So it makes a lot of sense too in
No.
terms of the supply side, right? People are living way longer right now too, and looking at just the age side of it
Yep.
too. So
Absolutely.
when you look at kind of targeting these, are you operating themselves? Are you partnering on them? Like how are you kind of entering these verticals too?
This is something, we own one of our verticals, which we might talk about, which is oil and gas. The other ones we tend to partner with. So on this one, we're partnered with a builder and an operator, and we're a capital markets partner for this group. And so that's how we participate in the space.
Got it. And let's also kind of pivot it, a little bit too. I know we are talking offline as well, and you've made a big bet recently and a big build out, right? Both on the company sides and then also kind of where you're allocating capital to going forward in oil and gas. So first,
Yes.
let's cover what that actually looks like to go bring that function in house too, from more the business
Yeah.
standpoint as your private equity firm, right? Because as a business yourself too, in this space, you don't make a lot of money up front, right? Your money is really made in performing on deals and back end if deals are structured the right way. So how do you think about kind of taking that, likely big investment to go
Yeah.
bring costs in house, and then also why the industry itself too?
So I'll kind of start with how we built this vertical in-house. I'll start with why, and I'll say that we've talked a lot about what's happening in the real estate space. I think that especially in the last 6 months, there has been a bit of a recognition among people who didn't really pay much attention to the energy space that the world still kind of runs on oil. And, with everything that's happening in the Middle East with Iran, and everybody's hearing about AI and the power demands of AI and not being able to meet them and needing to build, natural gas power plants in order to power these AI data centers. All of a sudden, there's a bit of a rotation in sentiment to the reality of the world's energy needs. And after trillions of dollars of investment, 83%, I believe, is the number of the world's energy is still fossil fuel dependent. And, is that a good thing? Not necessarily. We'd all like to see us move more towards green energy, and we are. But as we continue to build more green energy capacity, the goalpost keeps moving. we keep needing more energy. We keep consuming more energy. And so as geothermal and solar and wind and all of these, and hopefully nuclear, if we can get nuclear fusion figured out, that'd be incredible. All of those things are adding to the energy mix, but the goalpost keeps moving out because we keep, as a global society, consuming more and more and more energy. And then, of course, there's the petrochemical business, which a lot of people don't realize that anything plastic, it comes from oil. You need ethylene to have the feedstock to create plastics. And I mean, it really does fuel everything in modern life. I mean, from the time you wake up to making your cup of coffee to getting in your car, the road that you're driving on is made with butamin, which is a petroleum product. Your cell phone case, I mean, if you've watched Landman, you've probably seen that monologue. So in any case, that's sort of the why behind it is we're not ready to come off of fossil fuels, and there has been a chronic underinvestment over the last 2 decades. The tax benefits are undeniable, and it's a much less risky asset class than it was traditionally if you're investing in it the right way.
Walk through how the tax benefits actually work too. So to my knowledge, it has to be all working interest. So how do you structure that for investors coming in to actually claim the depreciation versus ordinary income?
Yeah, good question. We can get back to the piece about, why and how, we wanted to bring this in house. But the way that we structure this, there's different ways that you can participate in the energy space. You can buy minerals. That's sort of like buying a triple net, but you don't get income unless there's a tenant. And so you kind of have to wait around for that area to be leased, so to speak. The way to get the tax benefits is through drilling. So you either have to go out and drill a well, or you can be a non-operated working interest holder in a well that someone else is drilling. And that's what we do is we pool minority interests in top tier companies drilling projects. So we might take an EOG or Devon or, pick a name, either large privately held or publicly traded companies that are out there, and they're going to drill a package of, let's say, 10 wells. We might participate in that at a 3% stake. And that goes into a fund that has 30, 50, 100 wells that we have exposure to. And that's obviously going to blend the returns and reduce your risk. So that's our favorite way to participate is new drilling. You get those really healthy upfront tax benefits where you're able to write off 80 to 90% of your investment amount in year one. And then you also get very quick return of capital because unlike real estate where you're waiting maybe 5 years in this hold period to get your money back, oil and gas wells, specifically unconventional shale plays that we're doing, so horizontal wells that are going 2, 3, 4 miles laterally, those wells come on very strong in the beginning and then they taper off quickly, which isn't as good for an equity multiple standpoint, but your IRR gets jacked way up because you're getting a lot of that capital back. I mean, usually you're getting all or most of your capital back within the first 24 months. So very strong monthly distributions as these wells come online, and then that tapers off. And we typically hold the fund for 5 to 10 years, some point between 5 and 10 years. Our 2026 fund will sell off those assets and wind up. So long-winded answer for that, but that's sort of how we participate.
Yeah, and the big benefit there too is I think oil and gas is one of the few asset classes you can actually use that depreciation relative to.
That's the key.
Income. Yeah.
Yes. Yeah. Because real estate, usually that's a passive loss. So yes, you get a loss, but you can't use it against your W-2. Oil and gas, you can. So if you go to IRC, Internal Revenue Code 263C, or IRS Publication 925, it talks about you don't need to materially participate in order to get those non-passive write-offs.
I think that's a big thing too. Like people listening to this, people on social media, like you'll see it get pumped all day long if you can use depreciation in a big way. And
no pun intended.
Yeah. What usually ends up happening too is that in real estate, those passive losses will offset other passive gains. So in turn, your cash flow may be protected that you get in a real estate deal for a few years, but you're not actually getting a loss in that year if you don't have other assets that would appreciate it against.
Right. Or if you don't have passive income, I always tell our investors, it's like, it's not too late to start generating passive income because passive income is very easy to offset. Invest in real estate, either actively or passively, and you can offset your cash flow streams, your passive income streams very easily in that way. But if you want to write off your surgeon salary or your pilot salary, which is W-2 income, and that's active ordinary income, you got to find, you either have to materially participate in, let's say, a short-term rental, or you got to become a real estate professional, which is very difficult for anybody making that kind of money. Or you got to, oil and gas is one of the few silver bullets that high-income W-2 professionals have.
Got it. Now, why don't you walk us through kind of what that looked like bringing this function in-house versus just partnering on it?
Yeah. So obviously this is a strategy that we are very bullish on and very confident in. That's why we took, at great expense and great effort to bring these capabilities in-house. We were just doing a webinar a day or two ago with our landman, and one of our investors asked, how is your fund accessing these incredible deals, having just launched? This is in full disclosure, our first year in operation. And Corey said, well, Tait's hired some really good people that have very long track records. And so Mark Fleming is our managing partner of oil and gas. He's the chief investment officer of Waypoint Energy. He's been in the space for over 35 years, started his career at Chevron, worked for Hess, EOG, and then went and worked for Truist Bank, which was prior to that was SunTrust, advising on their reserve-based lending. So he goes to about 150 industry events a year, has an incredible network. Corey as well, our landman, has an extensive network. And so that's sort of how we brought these capabilities in-house. And so really my job as a CEO, any CEO's job, is to build teams, capable teams. And so we were very fortunate to find Mark. Timing was good for him. And we took those building blocks in-house and we were able to structure it in a way that makes sense for him to bridge to partner. And that's how we did. I mean, we found an incredible accounting firm that we're using. And so you put these pieces together and you make sure that they work well together, and you're sort of the conductor of the orchestra, so to speak.
Got it. And I know we were kind of covering too before, right? Like the transition from primarily real estate to now still in real estate a bit, but much more so focusing on oil and gas. Like, what do you see going forward for you guys, or kind of what are you seeing from both that and also kind of investors' point of view? Like, how are they thinking about shifts you've made in the business in terms of what's going on in the world?
Well, and to be very clear, we're not investing in real estate. It's just that we really like the oil and gas vertical. And to be clear, this will be our fourth oil and gas fund. It's just it's the first one that's completely in-house. I think, we were talking before the show about financial markets, macroeconomics, what's happening with money. I think that it's so important to realize that, I have the M2 money supply chart from the Fed pulled up. And in September of 2019, there was $15 trillion in circulation. And that's a combination. M2 is cash and debt, right? Today, there's 22.6. So, I mean, there is what?
50%, yeah.
50% more cash in circulation, more money in circulation today than there was less than 7 years ago. I mean, so what's happening to the dollar, the purchasing power of the dollar is just being decimated. And this is what Robert Kiyosaki was talking about in Rich Dad, Poor Dad all those years ago, and we all read it, is that the value isn't attached to anything. And I think that, there's another book that's really good if you haven't read it. It's by Ray Dalio. It's called The Changing World Order. And while I don't 100% agree with everything that Ray talks about in terms of the rise of China and the sustainability of China's rise to power, I do think it's a very, very good explanation of how empires rise and fall. And he studies the rise and fall of the French Empire, Dutch, French, English, and now the U.S. And there are differences in all of those parabolic curves, but but they say what history doesn't repeat, but it rhymes. And you can see the exact same things occurring in the meteoric rise of the American empire, and now cracks starting to form with rising debt, large disparities in wealth. So the wealth gap grows. There are internal conflicts, there are external conflicts, and when a country gets overextended in terms of its money printing and its debt, that's really the beginning of the downfall of the empire. And so I think that everyone should read that book, because it's a good one to have that knowledge in your back pocket, to be a good voter, a good steward of, and there are things that we can do, just like we can extend our own lives by exercising and eating right. We can extend the life of our empire by doing certain things. And so the problem is that with the debt to GDP ratio is now over 100%, and we have a massive budget deficit in the country, and politicians really have three ways. The government has three ways out of this, right? They can raise taxes, not going to happen. I mean, not meaningfully. They can stop spending so much. You really can't. I mean, you saw what happened with Doge earlier this year.
What about the whole,
I mean,
all the Nick Shirley stuff too, right?
Right. I
Go
mean,
into the government's like how they spend. It's, you know, the amount of money that's actually wasted there too is nuts. When looking at just
but very, very difficult to ratchet down government spending once it's approved. It's very difficult. Now we've got $1 trillion defense budget. It's going to be very difficult to trim that back in future years. Medicare, Medicaid, Social Security is all very difficult to ratchet back, because good luck getting reelected if you ratchet any of that stuff back. So are we going to be able to spend less? Not by any meaningful amount. So what option does that leave us? Printing money. You devalue the currency and you deflate, you inflate away your debt. And well, that unfortunately is probably the path forward. And that is going to hammer savers of dollars. So we want to be, Sam, I think you would agree with me, owners of hard assets, including real estate, commodities, oil and gas wells. I'm not a big gold guy, but there's something to be said for gold, silver, Bitcoin, that kind of thing. So you're getting your wealth out of dollar denomination into hard assets, because I think the next 10 years is going to be rough.
Do you think so? How do you think that plays out though now too? If you look at treasuries, they're through the roof, right?
Yeah.
Where if you look at how real estate's valued, so much of it's, yes, it's a tangible asset too, but so much that value is tied to what the debt on it actually is. Because if you're looking at it, most properties are 2/3 debt, right? When you first
Yep.
acquire them. So if you can look at that piece of it, yes, the hard asset matters, but the debt that's on it matters a ton too. And the relief there, which we thought we were getting, has not happened overall. Overall.
Couldn't agree with you more. And that's sort of the existential issue here, is that real estate is very sensitive to interest rates, and interest rates are higher because the world is losing confidence in U.S. denominated debt. You got to remember that your mortgage rate is not based on the federal funds rate. The federal funds rate is the overnight rate that the central bank lends to other banks. The longer end of that curve, which is what mortgage rates float up and down on, is the 10-year Treasury. And the 10-year Treasury rate is determined by demand for U.S. debt. So the more, either domestic buyers, it could be the Fed actually buying bonds, or it could be China investing in U.S. debt, or other foreign nations. The more demand there is for U.S. debt, then the lower it pushes those interest rates. And so that's one of these issues, is that if the world loses confidence in U.S. treasuries, it reduces the demand for U.S. debt, which forces, in order for us to print money, we have to pay a higher interest rate. And, it's this downward spiral. And so I think, it's a real predicament. I will say that real estate, at least on the commercial side, has seen a a very large devaluation in the last, 3 years from 4 years from 2022 at the peak when debt was very cheap to what it is today. I think that in general, it was overvalued. I think cap rates were artificially compressed in 2022, and real estate was generally overvalued in 2022. And today it's probably undervalued. And so when we look at the delta from inflation adjusted returns, let's say I'm just a cash buyer in real estate, I don't think that the real tangible value, if you smooth out that curve, is quite as dramatic a run up and a drawdown. But I think that that interest rates are higher for longer, unfortunately. And I think that we'll see that given the same interest rate, if we were to just say that interest rates are going to stay exactly the same, I think we will see real estate start to appreciate meaningfully in the next decade, although it may trade sideways for the next couple of years.
Yeah, because you also have the whole side of it too. Of you have these sellers who paid a lot, or kind of sellers paid a lot for properties. They likely can't sell at a certain price point. They have to go keep waiting. So I think what you're seeing is that unless debt forces it, you're not going to see a lot of transactions in general. I know just
completely agree. Yeah, I mean the whole thing is log jammed, and so I think there's going to be it. I mean, nobody has a crystal ball. We don't know where it's going, but I can say that, I mean, this logjam can't last forever. Eventually, transaction volume will return, even if 7% debt is the new normal. You paint a long enough historical trend of interest being 7%, people start trading based on those numbers.
Yeah, that makes a lot of sense too. So, kind of before we wrap up here too, like where do you see the future of your firm going as it relates to where did you look to allocate? Where else interests you besides where you are today, right? Now you've got real estate covered in a variety of areas. You are in oil and gas. Where's the most exciting thing to you outside those areas?
I don't know about outside those areas. Those obviously the reason those areas are our focus is because we think that they're the most exciting. I'm a big proponent of private debt. I think that as anyone ages and grows their net worth, we should all be looking at rotating more of our net worth into debt positions that pay cash flow. We should be turning equity into cash flow because you can't eat equity, right? But beyond that, Sam, I know that you're involved heavily in businesses, buying businesses. You're in the paving business, right? I think that there's a huge opportunity in baby boomers retiring and selling their businesses, and the roll-up strategy. It's just something that we haven't necessarily tackled, and I don't know if we'll tackle that. So, in terms of where we're going, I feel like we're really at this stage. I think that we are pretty fully matured in terms of the verticals that we're looking to participate in for the foreseeable future, really being private debt, a few asset classes within commercial real estate and oil and gas. And I think that we're pretty happy staying in those lanes. Of course, targeted opportunities do come up. We have a skunkworks division that houses our high risk, high return opportunities. And so occasionally something comes up where there's a VC fund or a startup that we really get intrigued by. And after a vicious cycle of due diligence, we may offer that to our investor base, but those are very one-off events.
Yeah, dude, I like what you said too about the private debt side of the house too, where it makes a lot of sense, right? If you're in the growth phase of your life and you still are, a pilot making $500,000 a year, you're likely better off pumping as much cash as you have possible into things that will grow more quickly. When you get ready to go take those chips off the table and go start living off the cash flow itself, your principal balance is therefore bigger, your yield's much higher, more consistent, you give up the upside.
Exactly. Couldn't be said better. And especially if you're young, because if you're young, you can take the hit. You have decades to recover. If you're 65 and you're approaching retirement, you don't need, if you've got a $10 million net worth and you're approaching retirement, it's like, do you really need a 3x return over 5 years? No, you don't. And you don't want to tie that money up until, God forbid, the project goes long and it holds for 7 years. You're 72 when that project goes full cycle. You don't really care it went 3x at that point. You just wanted the cash flow. So the older you are, the the closer you are to retirement, the more you want to be focused on the debt side of things. I think it's a very underloved segment of the investment world is the private debt markets. My God, I mean, you can get 10 to 15% nearly risk-free if you just look around for it.
Yeah, I think it's interesting now too, like what you're seeing in say multifamily right now. Like you look at most deals, they're 14, 15 IRRs, and most of that being back weighted return, where you can
Right.
get pretty similar returns in debt or credit or some vehicle that has predictable structured payments to it that you don't
Yep.
have a long lockup to. Like I like to think of it as liquidity adjacent. So if you're modeling of saying, okay, I need to go live off X every month, my buffer room or kind of runway is this. I can go extend my runway knowing that I can go tap this cash in 3, 6, 12 months and have a big chunk I can go pull down there. So you look at the peace of mind component of it, of how much cash you have access to versus what you spend. That piece is really important too in looking at the net return versus something else that has to go perform well for a long period of time to actually achieve that.
Absolutely. Couldn't agree more.
Cool. And before we wrap up here too, on your end, right? I know you have traveled a ton as a pilot, right? Can you give us your top few locations you have traveled to?
Ooh, that's a good one. So I do a fair bit of sailing, or at least I used to do a lot. I used to skipper for an international sailing flotilla company where we would get a lot of young professionals together and get on a bunch of sailing yachts. And that's actually got married on two catamarans 2 summers ago to my lovely wife Lucy, and with a bunch of friends. So I would say that's one of our favorite activities. And if you're going to do it, um, I'd say the Saronic Islands in Greece are absolutely fantastic, but you really got to go on a sailboat. So charter a boat. If you need to get a captain, get a captain. But there's a lot of companies in the Adriatic that will charter boats. The British Virgin Islands are also spectacular for that. Really just built for cruising. If you got kids as well, I don't have kids, but I have friends that do, and they've now brought their kids on these sailing trips, and the kids have an absolute blast. It's like Captain Ron. Beyond that, I'd say I'm a huge fan of Japan, the food, the skiing, the little tiny bars with 6 seats in it. It's super cool, and I could go on and on. I think I've been to 40 something countries, but I'll leave it at that short list for the listeners.
Cool. Yeah, Tate, thanks for coming on.
Thank you so much for having me.